For more on the jobs data and what it could mean for the next Fed rate decision, joining us now, we've got former Fed Vice Chair Roger Ferguson. He's also the former CEO of TIAA and a CNBC contributor. And Roger, this number, did it surprise you after that very hot ADP number we got?
It surprised me just a little bit. I think the markets maybe made too much of the ADP number, as in that has shown to be not always exactly a great indicator. You know, I think coming in slightly under the 225 suggests that the labor market is cooling, but marginally. Most importantly, though, the average hourly earnings number suggests still some firming in that space, and that's where the Fed has been primarily focused. So for me, this is, maybe a little lighter, but not a dramatic change in terms of outlook and expectations.
The one place this number was hotter was when it came to average hourly wages, month over month up 0.4% versus the 0.3% that had been expected. I mean, if the Fed's looking at it, I would guess that might be about the most important number they're watching.
I agree completely on that. The reason they've been talking about the labor market being tight is because it feeds into wages, which they believe feeds into the service sector inflation in particular. So I think you're right to point everyone to that number, and that number, again, slightly higher. So I think this certainly says that the market expectation of a 25 basis point move at the next meeting, I think, has been reinforced here. And I actually put slightly higher odds than I think the market is today on another 25 basis point tightening before we get out of this year.
Roger, the bull case, if you're looking at equities, is that, OK, even if you're talking about another 50 basis points, 2 more hikes from the Fed, you're still getting to the end of rate hikes, and that could be potential good news. Is there any reason you see to argue with that?
I think certainly it could be potential good news. If I were looking at the equity markets, the real question would be picking and choosing. There are some sectors that I think are going to slow more than others as interest rates continue to rise and, importantly, stay higher than maybe the markets currently expect. So I can understand the bull case saying the Fed's almost done, but recognize still how much has already been done in terms of interest rate hikes, and where we're seeing some slowing versus some forward momentum. The market, as you know, has been very focused on the very good news in the tech sector and perhaps downplaying some of the weakness in some of the other sectors.
All right, let's play out what you think odds are for a recession at this point, because for a while you had been more concerned that a recession was more likely than had been before. Do you still think that's the case? And is there the potential for a soft landing when you continue to see how strong the consumer's been and how strong the job market's been?
Well, certainly we should welcome the strength in the consumer spending and job market and job creation. Those, I do think, increase the odds of a soft landing. What I've said, and I still believe it, is a recession, if there is one, will be short and shallow. And at the end of the day, the distinction that we're going to draw between a short and shallow recession and maybe some sort of softish landing is going to be marginal. So I think overall my view hasn't really changed. Whether or not it's called a recession, others will decide that. But I think we'll have some more slowing left because, as the Fed said, and others know, the amount of tightening that's in the system, still more to come. And I think that does portend for some sort of softish behavior here, right on the edge of a recession, maybe a soft, shallow, short, shallow one, maybe a soft landing. What's
the most important number you look for next?
I think I still continue to look at 3 things. The JOLTS numbers, just to see if we're still in that 1.6, 1.5 openings per unemployed individual. Obviously, continuing to keep an eye on wage pressures, very, very important. So I think it's all about the labor market right now, Becky.
Okay. Roger, thank you. Great to see you.
Thanks.
Coming up next, what to watch ahead of the opening bell on Wall Street following the jobs report. Squawk Box will be right back.